What if I told you that one of the most influential banks in Silicon Valley collapsed overnight? That's right. In this video, we're going to explore the shocking story of how SVB Financial Group went from being a powerhouse of innovation and funding to a bankrupt entity in a matter of hours. How did this happen? SVB was founded in 1983 by former Bank of America managers Bill Biggerstaff and Robert Medeiros to focus on the needs of startup companies. They came up with the idea over a game of poker. SVB offered services such as venture capital financing, loans, deposits, treasury management, foreign exchange, and more. It had over 40 offices around the world and served more than 30,000 clients across various sectors such as software, hardware, fintech, and e-commerce. It was often seen as a partner and an ally for tech entrepreneurs who wanted to grow their businesses and innovate. SVB went public in 1988 and expanded across the US and internationally. It backed young tech startups during the dot-com bubble of the 90s, but avoided disaster when the bubble burst in 2001.
.com shot up today.
We're on track, it looks like, to hit 1 billion shares today.
Internet stocks drove a powerful surge on Wall Street.
Siliconvalleybank's strategy during the dot-com bubble was to focus on building long-term relationships with its clients. SVB took a conservative approach to lending, which meant that it only provided financing to companies that had strong business models and were likely to succeed in the long run. This allowed SVB to avoid the risks associated with the speculative investments that many other banks were making during the bubble. When the dot-com bubble burst in 2001, SVB was well positioned to weather the storm, while many other banks suffered losses from their investments in tech startups. SVB's conservative approach to lending and focus on long-term relationships allowed it to avoid disaster. SVB also had a strong balance sheet and a diversified portfolio of clients, which helped it to weather the downturn. In the aftermath of the dot-com bubble, SVB continued to support its clients through the difficult times, providing them with additional financing and other support to help them weather the storm. This approach helped SVB to maintain its reputation as a reliable partner for tech startups, and it continued to grow its business in the years following the bubble burst. But behind this success story lay some serious problems that would eventually lead to its downfall. The main issue was that SVB invested too much of its deposits in long-term U.S. government bonds that were backed by mortgages. These bonds were considered safe and stable investments that would generate steady income for the bank. However, when interest rates started to rise rapidly in late 2022 due to inflation fears, these bonds lost value dramatically. This meant that SVB had less capital to meet its obligations and regulatory requirements. It also meant that it had less cash on hand to deal with customer withdrawals. And withdrawals were what triggered the final blow for SVB on March 8, 2023. SVB announced that it needed to raise $2.25 billion to shore up its balance sheet after selling some of its loss-making bond portfolio at a $1.8 billion loss. This shocked investors and customers who realized that SVB was in trouble. Within 48 hours, customers withdrew a staggering $42 billion of deposits from SVB, causing a massive bank run that drained its liquidity. Regulators intervened on March 10th and closed down SVB, putting it under the control of the Federal Deposit Insurance Corporation. This was the second largest bank failure in U.S. history after Washington Mutual in 2008. It was also a huge blow for the tech sector, which relied heavily on SVB for funding and banking services. The consequences of Siliconvalleybank collapse are still unfolding, but they are likely to be severe and far-reaching. To avoid future disasters, banks need to diversify their assets and manage their risks carefully, especially when dealing with volatile markets or interest rates. And regulators need to monitor and supervise banks closely, especially when they serve critical or large segments of the economy. That's all for today. Thank you for watching, and don't forget to like, share, and subscribe for more videos like this one. See you next time.